Hey everyone, thanks for joining us. Really excited to talk about this topic. It's something that has bothered me for a long time. And, I really think this may be a bit of a breakthrough in how we work with backtests, and particularly how we identify when backtests and our strategies can work really well and when they don't. So very, very important topic. And as I said, really excited about this. Before we start, I want to sort of really just level the playing field a little bit and talk about how we make decisions generally in trading, but also how technical analysis and quantitative analysis fits into the decision flow process, because it's very important that we understand where quant analysis fits in, because this is going to be a quant heavy presentation. I'm going to try and present it in a way that is not, we don't get stuck down in numbers too much, and I can make it as clear as possible. But we are doing quantitative analysis. There is a lot of work there. So let me just jump straight into this. Now, obviously decision workflow, what are the components of an investment decision? What are the things that we need to have before we can make a decision to trade, to advise our clients, maybe to make a recommendation in a newsletter? Those are the sorts of things that we need. We need to know what are the parts that lead up to that. Where does TA fit in? How does that fit into the decision process? And same with quantitative analysis. Where does that fit in? So what we'll do is we'll start by looking at this workflow. A very simple way that I'd like to present it is this. We have information. Based on that information, we develop an idea. And then because of the idea that we're developing, we act. And that act may be trade, as I said, or advise clients, etc. So information could be anything from a price chart to news, maybe a rumor. In the olden days, beginning of the 20th century, it would have been looking at the ticker tape. That was all information. I would even think that this is actually primary information. It's information that's freely available and hopefully freely available, maybe some insider information there too. But nevertheless, this is the information that we use to develop our ideas. Our idea, we observe something, we have a thesis about it, and then we have a interpretation. And then from here, we either trade or we advise or we write a newsletter, whatever ACT means for you. If you're a private trader, obviously ACT means trade in that equity or in that security. If you are a PM, the same. You may then tell the traders to trade on your behalf. If you're an analyst, it may be that that acting is telling the portfolio managers, this is what my opinion is on these stocks. No matter what we do, we all have skin in the game. A trader has no more skin than an analyst, because for an analyst, our reputation lies in the stocks that we recommend. So, acting still has risk associated with it. As far as information goes, it may be that it's rumors that we're working on. And so if that was the case and we had a really good source and they'd come to us 10 times and said, hey, I think that this stock is going to go up really high, and every time that actually happened, well, that's our observation. So we developed this idea that, when this person comes to me, they know what they're talking about. So I now have, the information I need to act. But where does technical analysis fit into this? Is it another source of information? Is it the idea? Is technical analysis that part? What I'd like to propose is that technical analysis is fitting between information and idea. In fact, technical analysis is based on primary information and we're creating derived information from it. So probably I should have drawn this a little bit differently, but nevertheless, you get the idea that it slots in between primary information and our idea generation. Now, in a holistic view. We may take primary information, for instance, price, and we may take our indicators and develop our idea based on the two of those in tandem. We still have an observation, we develop a thesis, and we act on it. So if I was looking at an RSI, and I looked at a lot of RSI charts, RSIs on charts, I should say, and I could see that every time it was below 30 in the oversold territory, that market would turn around and there was a good short-term buy signal there. Well, that's my thesis and my interpretation of that technical analysis indicator, and then I can act on it. So technical analysis on its own is not a signal. It's our interpretation of it that develops signals. Crossover of moving average is our interpretation of when we should trade based on the technical analysis. Technical analysis is really just derived information, or secondary information is another way to think about it. So for us to act, what do we need? What's the most important thing we need to go and act and either trade or advise, write that newsletter, etc.? Because as I said before, every time we act, we're taking on risk. There is risk that I could be wrong and that I'm going to lose clients. Or if I'm a portfolio manager, I may lose funds in the fund. And so, obviously having assets under management is really important. Same with newsletters. I may lose subscribers if I continually be wrong. So we've got to have that ability to overcome the risk. And what allows us to do that is confidence. Confidence in our idea. That's the real key, because if we develop this idea, this thesis, we need to have confidence to be able to act on it. So confidence in our idea allows us to overcome the risk of being wrong. Now, given that, and given that's so important, where does quant fit into all of this? Because a lot of people really have the opinion that I'm either a technical analyst, a fundamental analyst, or a quant analyst. I disagree with that, and I'll show you why in a moment. It's not a form of derivation. It's not like technical analysis where we are taking primary information and creating derived information. That's not where quant analysis comes in. It's not machine learning. Machine learning, I would say, is another form of derived information. And based on what the computer models tell us, we decide to act. Now, you may automate that process, but that in itself is a decision based on looking at the results. Quantitative analysis is completely separate. I would actually say that it slots into this little workflow right here. Once we've developed an idea, we then need to test how good is our idea. Now, in the past, we may do that anecdotally. We may look at a chart and we may see our signal and we see that every time that RSI was below 30, the market would go up. And so we have this almost heuristic way of looking at it and saying, okay, that's a good rule of thumb. That's my quantitative analysis. As computers have allowed us to create these rules and these signals, we're then able to test them much more thoroughly. And so this is where quantitative analysis fits in. It's not another branch of financial analysis. It is really the measuring of how good our ideas are and whether we can have confidence to act. And I think that's really the key there. So quantitative analysis is the analysis of our ideas. Favorable results give us confidence. And that's the really important thing. Remember, it's not that our ideas are systematic or not. It's almost like we don't even care whether it's a discretionary idea or systematic. Now, systematic is easier to test because it's all part of that one process. But I could be using a very discretionary way of looking at a security as long as I'm noting down all of the signals I see and I'm being really disciplined and true, honest with myself about that. Then I can develop quantitative testing on all of those signals. I could do it manually. It would be a hard process, but I can still do it. That doesn't mean that only systematic ideas can be quantitatively tested. Right, so that's leveling this idea. I wanted to make it very clear where quantitative fits in. What we're doing right now in this next section of this presentation is all based on quant measuring of an idea, and then seeing how we can improve that and seeing where things went wrong. So where this journey started, probably back to 2015, 2016 for me, we developed Optex Bands, Carson Dahlberg, who was working with us at the time, and myself built on this idea. Now, go back another few years before that, I'd created this tool, Dynamic Market Profile, which was taking the concept of market profile and making it into a dynamic indicator. And then we were working on this. Now, I do have a completely separate webinar on that. It's at optuma.com/optex. If you want to find out more about this indicator, how it was built, etc., you can look at that. Suffice to say that when we developed this indicator, we were getting some great results. Now, the primary signal we would use is when this ratio line goes into this dynamic oversold zone. And we would get these. You can see these with these arrows here. You know, they're great signals. Not always perfect, but nothing ever is. You know, there's always going to be the risk that our signal gives us a bad entry. But so long as we've got lots of good entries and good returns from them, you know, we can wear that risk. So yeah, it was a great indicator. Now, I have a test period between 01 and 09. I talk more about that in a quant video, which I'll show you that link in a moment. But in that period, when we were testing this, we had annualized returns of 21.8%. You can see in yellow there. At the same period, and this is why we chose this 2001 to 2009, the index had annualized returns of only 1.3%. So we were getting massive alpha over the index through that period. Now, you watch any of my older videos on quant and even the Optex video, I will tell you in that video why we chose this period and why this means that our strategy is giving us alpha, because we're dealing with a flat market, and so that's a really good thing. And, you know, I honestly believe that to be the case at the time. I'm now questioning, as you will find out as we go, but nevertheless, that's where we were coming from. Moving forward, I just wasn't seeing the results match what we were getting in our test period. And this, you know, obviously really bothered me. So looking here at 2012 to 2022, a 10-year period, a little bit longer, but nevertheless, I'm getting annualized returns of 8.8. If you look at the green highlights there, my win rate is about the same. So the amount of times that my trades actually ended in a profit were about the same. But if you look at the annualized returns of the index actually did better, and you can see that in the chart here. We can see our S&P index here, and the blue line is our total equity. And yeah, just a buy and hold strategy for that 10-year period would have done better than what I did with this strategy. And that's what really bothered me so much. Another one quickly, and I'll talk about p-values in a moment, but in our initial test period, our p-value was down at 5%. P-values are very important. The lower the better, and we definitely want them below 5. That means that within 2 standard deviations, this is a really significant, you know, we're really adding value with our test. I talk about all of that in the quant video. I don't want to repeat that now, but you can see that in the 2012 to 2022 case, I have a p-value of 95%, and that is terrible. That is just really, really bad. Look, in all honesty, when we talk about p-values, the actual scale isn't that important. It's just getting over that threshold of 5%, so, or under that threshold, I should say, of 5%. That's the important thing. But nevertheless, I can see it already on the chart that I'm really not adding that much value at this point. So we looked at this, and I really had to say, you know, when we developed this tool, we weren't overfitting. We weren't going through and tweaking the parameters and finding the best set of parameters that would give us the best results. We developed a thesis, and this is the way that I would say that anyone should approach creating a new indicator or a new idea, trading strategy. We developed the thesis first and said, you know what, on a market profile type scenario, when price gets down into the third standard deviation, we've got this excursion away from price. And essentially that's the bones of what we're doing. We have some volatility adjusting going on, but nevertheless, that's the bones of it. So I was happy with the thesis of what we developed. There was no reason why I would have thought it shouldn't have worked better in a bull market than it did in a flat market. Because at the end of the day, the whole concept behind a mean reverting trade is I have a primary trade going up in a bull market, and then I have this secondary market, so Dow theory, this secondary reaction, and I'm trying to capture those. And if I can capture those and then go up, I should get a really good result. But I obviously didn't. Now, if I was developing this idea in this market, I probably would have thrown away this Optex bands idea and never pursued it, because the results just weren't there. I just wasn't getting what I needed from that. So this is just something that I just had been stewing on for a number of years. And that's often how these things work. I often, either I'm sitting with a client and I hear what they're trying to do, or some area that they're struggling with, and I just stew on that for years and years until suddenly a really random conversation will trigger something else, and then off we go. So that's really what happened here. Now, some of you may know that I teach the CMT curriculum, all 3 levels, with video courses. And as part of that, for students who sign up to our courses, I answer their questions in a forum. Now, one of the things that we teach, I think at CMT 2 level, is the whole idea of intermarket analysis and leadership of asset classes. So be it bonds and stocks and commodities, and then the US dollar from a US perspective, but other currencies from other locations. And in that, I had a CMT candidate who asked me about performance of ideas and strategies within different phases of the market in this idealized intermarket analysis model. And that's when the light bulb went on. And I thought, well, hang on, maybe this is the reason why my strategy works so well initially and then stopped working. Because maybe we've actually changed phase and we're in a different phase and a different relationship between the bonds and stocks, for instance. And so this is what I wanted to dig in and find out. So here's the idealized model where we have, typically this is the way we teach it, that bonds roll over first. So you get a peak in bonds and then they start falling down. And then you get a peak in stocks and you get a peak in commodities and eventually a peak in dollar. And this goes over and over. And if you look at monthly charts on all of these securities, you can kind of see that. It's not always as simple as the idealized case, and that's with many of these things. But the theory is quite sound, and you still see this happen again and again. But it's very interesting. Now, there's always an economic reason why this happens. So, you know, one of the easiest relationships to look at is stocks and commodities, because we have a point of stocks. The stock markets, the price of shares are going up. Companies are spending money and expanding and building new products because there's all this investment into their companies. And to do that, to do all this expansion, they need commodities. And so we get then, obviously, that we start getting the rollover on the equity market, and suddenly they're starting to lose that money that they had, but they've already got orders in for the commodities. So the commodities are still going up because there is still that demand, there is still the commodities being built, and manufacturing. There's a manufacturing phase going on there. So there's an economic reason which explains this whole intermarket model, but it's really, really important. Now, the thing that has always bothered me is that this is great from a theoretical point of view, but what I wanted to do was be able to define which asset class is leading, and can I then use that as a metric when I am doing my quantitative testing to determine how my strategy works during these different phases of leadership. And there's a really important note here as well. There's one thing to define these things historically. So when we talk about inflation, when we talk about recessions, we talk about them in a historical context. We can't always know today what the inflation number is. So that's why I can't use something like inflation as part of the inputs in a model like this. It has to be something that I can calculate today and it won't change. It won't get restated in 3 months' time because some economic data got released. It's got to be consistent. And so that's what I was looking for as well with all of this. So this is the result of that analysis, looking at each asset class, comparing it to the other three, 4 data files here, looking at them in a relative basis, working out which one was leading compared to the others, and then applying a volatility filter as well, just to smooth out a little bit of the noise. And what we can see here is that on this chart, and I'll expand this in a moment, but we have stocks when the chart is highlighted blue. Now, what that means is stocks is leading all other asset classes. So if you were comparing stocks to commodities, stocks is outperforming. Stocks to bonds, stocks is outperforming. Stocks to dollar, stocks is outperforming. And that's highlighted in blue. And then we have the green when bonds are outperforming. And so you can obviously see that right at the right-hand side of the chart. We have bonds in a phase where they're leading. We know that the banks in middle of 2023, we've just had massive increases in mortgage rates and Federal Reserve rates across the world. So that's not surprising. The rust or ochre color there is when commodities are leading, and very interesting, not all the time, but you'll see when you look through that near the end of many of the commodity of the equity market runs, remember this is the S&P 500 chart I'm looking at, we have commodities leading. So even in 2022, commodities started being the leader and then the market turned. So again, that's like a real early warning when there can be problems in the market. So very, very much something we need to keep an eye on. And then dollar is when the market is white there. White background is when dollars lead. We often talk about when we're in panic situations, 2007, 2008, everything correlates to 1. That means that they're all losing value. And of course, by virtue of that, the dollar is outperforming everything else. And you can see that happening in many of those down markets. So if we just expand that, just to make that a little bit bigger there so you can see that chart, you can see those zones and how they work. So this is really great because this gave me a very objective measure that I could use on my signals. So what I did is we did this with signal testing. Now those results I was showing you before was actually a back test because I was comparing back tests. I'd already been through the signal testing process at that time. Remembering a back test, you're dealing with an entry rule, an exit rule, a starting capital, position sizing rules, pyramiding rules. There's so many rules, which is good, and we need to do that. But that's not where we start. We always start at the signal testing part about that. And I talk a lot more about that in this video. at optuma.com/quant. I also explain the p-values and how they're calculated as well. We do that a little bit different in a bootstrapping mode as well. With a signal, all I want to do is find every single instance of my signal across all S&P 500 stocks, obviously when they were in the S&P. So there's like 800-900 stocks now that have been historically in the S&P 500. We only take the signal if it was in the index at that time. Very important. But we find all instances. We just measure the returns over 63 days, which is 1/4 of trading day activity. And then we average those results. There's no exit rule. I don't care about an exit rule. All I want to know is, what does the market do after my signal, for the next quarter after my signal? That's the key of what we're looking at here. So here we have our results. We've got the down here, all signals. So this is for all the signals, forgetting the phases that we were talking about. And then we have stocks leading. How many signals did we get? What's our probability of gain? Bonds leading, commodities leading, dollar leading. And we can see here when we look at the probability of gain that when stocks were leading, our probability of actually making a profit is lower than when the dollar was leading. And then, if we come down to average returns, we can see that our average return is only 2.5%, whereas when the dollar's leading, it's 6.6%. Standard deviations, there, the p-value, again, remembering we want to be below 5. When we are below 5, that's telling us that our strategy is significant. We're really onto something there. When stocks were leading, 98%. That's terrible. Can hardly get worse than that. Bonds leading, commodities leading, in the middle. So it's not really giving us any real clear indication. But when the dollar's leading, our strategy has a p-value of 2.7%, which means that this is really, really significant. We, compared to everything else in the market, this is significant. And so this is definitely something that we should be holding on to as part of our strategy. Now, I have got to say that this blew me away. I expected, Dow theory, all of that sort of stuff, that when stocks were leading, my mean reverting strategy, buying long in a upward trend, was going to do the best. But that's not what we found. And in some respects, I guess I should have probably anticipated that, because that period from 2012 to 2022, when my strategy was doing poorly, was a stocks leading environment. For a big part of that, stocks were outperforming. And so I shouldn't have been so surprised, but it really challenged my belief. And again, I think that's an important part about quantitative analysis, is that it can challenge us where we may have misconceptions and we're trading with misconceptions versus being able to really dig in and see what the numbers really tell us about our strategy. So adding in at the bottom, just what the index did during those periods as well. You can have a look at those numbers. But what I really want to do, because if all I do now is show you lots and lots of numbers, this is going to get really mind-numbing very quickly. So what we've developed is this star rating that you see down the bottom. Now, you can see for all signals, this Optex band gets a 3-star rating. When stocks are leading, it's only 1 star. Again, very disappointing in that. I was completely opposite of what I expected. Bonds leading, we get a 3-star. Commodities leading, 1 star again. And then when the dollar leads, we get a 4-star. Now, again, how can that happen? We've got the market tanking, dollars leading, yet we're getting 4-star. And what I've realized by going through and hand checking so much of this is that, I'm getting a lot of signals, but many times when we have this fall in the market, the market turns around. And so we get these signals, the market turns around, and we end in profit, and we get much better probability of gain, much better returns, etc. So again, that's this mean reverting signal that we're looking at here. So the rating's made up of a number of metrics. And it doesn't just mean that it's a high profit, because there's a lot more to it. It's like that strategy that I was showing you. I was making 8.8% return per year, which was not a bad return, but the market, if I did buy and hold, was making 11.3%. So profit alone isn't enough. We need to look at a number of different metrics. So the inputs into the Optuma quant rating that we're developing is p-value, obviously smaller the better, like we've talked about. The spread between the mean and the median, because if I have a lot of outliers, then I can really pull my mean average up, but my median average may be down. And so if I start getting a big spread between those two, I need to be really careful of that. And so we want a small value of that, and that gives us a good score for our star rating. Average return versus index return. Like I just said before, I want to see a big spread between that. I want to see that my strategy is adding extra alpha over the index. Otherwise, obviously, that impacts our star rating. Standard error. This is something that we're working with, and you would have seen that on the previous grids that we had standard deviation and standard error. Standard deviation is affected by positive and negative, I guess, dispersion around the mean. And so that's something that I always have a little bit of a problem with, because if I have a wildly successful signal, I don't feel it's really fair that we add that into the standard deviation, given that thanks to Markowitz, we all think of standard deviation as being a measure of risk. And to some extent it is, but nevertheless, I do have a little bit of an issue with that. So what we use instead for the star rating is standard error. Now, what we do there essentially is we take the standard deviation and we divide it by the square root of the number of signals. So the more signals I have, the lower the standard error will be. But if I've only got 10 signals, then I'm hardly going to bring down that standard deviation, and my standard error will be a fairly large number. So I'm looking for a small standard error. Win rate, how often does my strategy win? Ideally we want to be in the 55 to 75 range. If I can get into that range, once I'm above 75, I mean, it's almost 5-star just on its own, because that's such a powerful signal. But the win rate's very important. Profit factor, which factors in the win rate by the average win size as a ratio against the losing rate by the average loss size. So all of this comes to the star rating. This is what we're going to use from this point on. So we won't bog down into those numbers. Phases were obviously good. We got a few 4-star ratings there. It was really interesting. The next thing I thought was, what about if we go deeper, another level deeper, and not only just look at which asset class is leading, but which asset class is in second place. So, it may not be beating stocks, but is it beating the other two asset classes? And this gives us 12 unique combinations that we can work with. So here are the results for that as star ratings, like I said. The top line here is the standard with just looking at the leadership. So stocks leading, bonds leading, commodities, dollar. This is from that grid that we had before, 1 star, 3, 1 and 4. Then what we have is the second level. So obviously when stocks are leading, stocks can't be in the second level, so it's blank here. What was very interesting to me was immediately here. So when commodities were leading and stocks were in second place, we actually had 4-star rating, which again, things that I would not have expected. So it's really interesting as these sorts of things happen. So again, commodities are number one. They're outperforming everything else. But stocks is now outperforming the dollar and outperforming bonds, and we get a 4-star rating. So had I not looked deeper, I would have taken these results and said, you know what, when commodities lead, I'm out, I forget, put my strategy on the shelf and find something else. But this is saying to me, no, hang on, you actually can trade this. There are actually some good opportunities. A 4-star strategy is a good strategy. And so this is good, but only when stocks are in second place. When bonds are in second place, it's 0-star. And when the dollar was in second place, we didn't even get any results at all. So that never actually happened. And then we obviously look at these two. So we have bonds leading, and then when stocks again are in second place, then we get a 5-star return on this strategy. But if we take the converse of that, when stocks are leading and bonds are in second place, we get 0-star. Now, again, economically, I can understand that. So we've got a big equity market going up. Stocks are leading. The other three have been beneath. But then we get bonds. They're bubbling up. The central banks are starting to raise interest rates, and bonds are starting to rise in price and their returns, I should say. And so, yes, if I was to take a long signal in that environment, we've seen many, many times that the equity market will roll over. So if I'm going to take a long signal, then that would be a terrible time. 0 stars is what I get from there. So this is a chart, again, that same 30-year period, looking at those two cases. So the green highlights are when bonds are outperforming everything else, but stocks are in number 2 place. And you can see, other than this one where the market just went sideways for a little bit, we've got our zone here and a move up, our zone here moving up. It just seems that every time we get into this situation where bonds are leading, stocks are in number 2, we move up. And very interesting that we are right in that phase right now. As I mentioned this in the middle of 2023, we are in this phase of bonds leading, stocks second. It hasn't been too short. There's been a couple which are a little bit shorter, but it's been a significant period there of bond leadership. And so, I guess what I'm saying is I'm actually very bullish for the next couple of years based on what I'm seeing right here. And I know there's a lot of people who are very bearish, so we'll see how that goes over the next couple of years. But on the data presented, I couldn't say otherwise. Stocks leading, equity market goes up, stocks leading, bonds start going into second place. After this, probably bonds went into first place, and I think we would have seen that on the other chart. But then the market rolls over, and this again would have been a terrible time to invest. Not as consistent. I wouldn't say that these are, even these are little ones, but I wouldn't say that it's as such a high hit rate as we have on the green ones, but nevertheless still significant. So that was really amazing. The results we got there, we got some 5-star results. It gave me the ability to say, right, I've got these 12 zones that I can look at and start really deciding when I would follow my strategy based on these phases. And it also answered that question about why did my strategy work through that initial test period and then stop working after that, because obviously we were in those zones of equity leadership. And, if I could have filtered out when I took the signals, that would have been better. But what I wanted to do was go even further and say, right, I've dealt with what we would call systematic measures. This whole bond, this affects the whole market. And what if we start looking into some idiosyncratic measures? So things which are related just to the security. And so we looked at a number of measures, number of technical indicators relating and seeing how can we group securities. So all the stocks in the S&P 500, how can we group them and create this idea of measuring the quant results by different groups. And what we landed on, and don't worry about this image, I just needed to find a complex image to show how complex this all is. it actually is an interesting image. I am looking at that as a way of displaying some of this information, but I'm not sure yet. So two that we came up with were beta and volatility. Now remember, beta, it's the relationship or the sensitivity of the stock to what happens in the index. So a high beta stock, index goes up a little bit, stock goes up a lot. Index goes down a little bit, stock goes down a lot. So that's a high beta stock. Low beta, index goes up a lot, stock goes up a little bit. So it's a lower sensitive stock. Volatility, on the other hand, is just within the security itself. So we use an ATR, standard volatility measure, but divide that by its close to get a ratio. And then what we did is we went through the Russell 2000 and said, right, let's take all these stocks and let's put these into 5 bins and work out the thresholds of what would constitute a very high volatility or a very high volatility stock versus a very low volatility stock, and put that into those 5 groups. So by doing that, running this process again through our new quant engine, we were able to get some really interesting results again. And again, I've been blown away by some of this because remember I said stocks leading was a terrible scenario, and there was very few times where we would make any money from our strategy. Yet, had I just traded low beta stocks when stocks were leading, then I get 5-star result on this. And again, even with bonds, when bonds were leading, obviously we got 3-star, but it goes out to 5-star when it's a low volatility stock. So very interesting. And I guess what was most interesting to me is that I then went through each of these groups, and because there's lots and lots of these characteristics there, and I measured, okay, which was the best grouping. Now, let me just clarify something. I didn't apply the second level of phase leadership. So I didn't take bonds and then stocks. I just did the one. So just bonds and then looked at the characteristics of the securities. It was just going to get too much data for this one. But nevertheless, the best characteristic here for stocks, we can pretty much see that by the star ratings. It's going to be low beta and low volatility, and that's a 5-star result there. Again, 5 stars. Again, it's low beta, low volatility. Low beta, very low volatility in commodities was the better one. And then low beta, low volatility. Again, p-values are off the charts. That's so incredibly small. There's no doubt that this strategy is adding value at those times in that environment with those types of stocks. So again, that's what's really important. So this is all really fascinating and good, and I hope you sort of appreciate why I'm so excited about the breakthrough here that we've been able to make. But obviously we're a technology company. None of this makes any sense if we can't get that into people's hands. And I think that's been a real issue. I think whenever I've looked at people presenting new ideas and they talk about their back-tested results and things like that, it's always been with an element of frustration, because how can I take away this? How can I overlay this into my own process and build this around my models, etc. So I think a couple of key takeaways from this right now, I think first and foremost is understanding the impact of phases. I've given you an example there of using Optex. I've actually run this whole model as well. Typically those calculations, I can throw something at our new quant engine server and it will spit back all of that information probably in about 2 minutes, something like that. So it's not arduous. I can just throw different ideas at it all day. It's been really interesting. Most technical analysis, long-only ideas make money at the same time. So the actual specific indicator actually has less to do with the profit, and don't stone me for saying this, purist technical analysts, but that's just what I've found as I've gone through and done this research. so important that you know when your strategy works and when it doesn't. And when it works, you adjust your position size accordingly. You are all in that environment with your technical idea, because this is when you're making money. But also when your strategy doesn't work, and saying, right, either I buy and hold, I go to cash, I find a different strategy that works in this market environment. That's the goal. That's what we're trying to build, is to get to that point where you can have hybrid strategies and you're getting the signals from them, but the strategies are being monitored as well with tracking errors and things like that as we go. A really sound model is always going to be a hybrid. We're never going to have this one indicator idea that makes us money in all market environments. So we need to be able to switch between which models that we're using. Even if your ideas are discretionary, I think that's the other thing, you can still be quantitative. That's another takeaway that I hope that you can take from this. Now, what we're working on, like I said, we've all talked about quant modeling, and we even in Optuma, we've done it where, okay, you can build a script and this idea, and you can put a show bar on Optuma and you can see what that looks like. And then you can go and say, right, let me do a signal test on it. And you can do the signal testing of it and find all the instances of your signal and do that calculation. Obviously, now we know with phases that we can do this deeper analysis, but nevertheless, that's the way we would do it. Then you would take that script and say, right, I want to do some trade testing. I talk about that in the quant video, why trade testing is important to do before back testing. And then finally you go into backtester and build a model, my entry rules, my exit rules, my position size. I know how this signal goes, so I can do this backtesting phase now. And then if I'm happy with the results there, I would take that script again and I would put it in the scanner, and I would be scanning the market every day, waiting for those signals. It was all very piecemeal. And what we're trying to do again with our new whole products that we're building is make this a very much unified workflow. Now, we are not done. I don't have a product for you right now. It very much is a work in progress, been very much slowed down by this breakthrough, because it's taken a lot to build all of this into our analytical quant engine so that we can get these results out. But I hope you agree with me that it's definitely something that's going to add value to everybody. When we go to these conferences and you see someone develop an idea, unless you're a geek and you like programming in Python, it's never been easy. And again, I talk to so many people, so many professionals and retail traders who feel this need that they have to learn how to program. If you can and you have a disposition towards that, that is great. Obviously, as a programmer, I have to say that programming is a really good thing to do. It helps you understand things. I think when I learnt technical analysis, programming the technical analysis is what really cemented into my mind how these things work and how they can be used together. But it's not for everybody. Some of us are money managers, some of us are analysts, some of us have clients that we've got to work with. We don't have time to go and learn how to program. That's again what we're trying to do. We're trying to save you from having to do that. Yes, there's scripting, and even there we're trying to see if we can use AI to help generate scripts, because our belief is you are an analyst, you are a trader, you are a portfolio manager, you shouldn't have to be a programmer. Let us do that. So that's the direction we're taking. Simplify the workflow, simplify the ability to create these ideas and do all the quant testing you need to. So our new web portal that we're building for this is like the scan results page that we've got there. But the goal is that you can put in a script and then immediately it tests it. And if you're happy with that, you take it into the next phase, which is trade testing, and then into the next phase, which is back testing, and you build the model. But then also this whole idea that you can publish a signal. So maybe you create a signal and you say, hey, I'm really happy with this. I want to publish it. Now, again, we still have to work through all the commercialization of that, how publishers get rewarded and things like that. But that's the model of what we're working towards. But where, again, I think it's so important is the ability to combine multiple strategies and have those strategies switch. So you can say, right, when stocks are leading and bonds are second, this is the strategy I want to use. But I'm only going to take it if the stocks are low volatility. And then if otherwise, I'm going to use this strategy. And again, these star ratings, which are not highlighted on this example here, but they would also give me the idea of, yes, here are all the stocks that I've gotten a signal for today, but this one is only 3-star, this one is 5-star, because maybe it's low volatility and low beta. And so I get that quant rating right here when I get my scan results, and I can decide whether I'm going to take that signal or not as well. So again, we have the confirmation of the current phase, the star rating based on the idiosyncratic characteristics, and then the expected return based on the quant analysis as well. And then we're building in some technical ratings and fundamental ratings as we do that. So this is what we're working on. I know for many people, I've been saying, I'm building a new quant engine. I've been doing this for like 4 years. Most of the engine part is done. We're now just building the interface into that engine as well. And so that's where we're at. We're hoping Q3 that we're going to have the first phase of this out for beta testing. It's just going to be a free beta. As I said, we haven't even worked out how we're going to commercialize it yet. But for a limited time, you'd be able to use it for free. And so you can do that. Phase 1, signal testing, daily scans. Phase 2, watch lists and pages and layouts and things like that. And then, phase 3 is really getting into the quant-driven hybrid model portfolios as well. And so if you'd like to sign up for the beta, you can scan that QR code, or you can go to app.optuma.com, and either way, the QR code just takes you there. You can sign up there, and as soon as that beta is available, sometime in Q3, we'll let you know about that. So thank you very much for taking the time to watch this webinar. I certainly hope you agree with me that this phase concept really unlocks so much information, and I hope that it helps you as you develop your own ideas, but also understand when your trading may work and when it may not, and when to use technical analysis, and maybe when there's a different strategy that you need to use. So again, I hope this has been beneficial to you, and thank you so much for watching.